Good afternoon and welcome back to Markets Today. If you're just joining us, the rate cap conversation is one that is becoming long and unwinded, but it's imperative that we just make sure that we are crossing all the T's as well as dotting all the I's with regards to any possible investment repercussions, whether at a macro level or at a micro level. In studio, we are joined by Mr. George Munga, who is an economic analyst. We're looking at the totality of the possible impact of the rate cap repeal at a macro and at a micro level. Welcome to the show, Mr. Munga.
Thank you.
What are your initial thoughts? Total rate cap, what was your sentiment when it was happening and after it happened, and what are your thoughts when you think about it?
Having a banking background, I've been a strong proponent of a free market economy and a free money market, market in the country. Why do I say this? The money market, just like any other market, is controlled by the forces of demand and supply.
Okay.
Supply in this case is the credit that is applied by the banking sector or the financial sector, and the demand from now government and the common populace, that is the private citizens. When there's an equilibrium, then now the cost of credit is determined by the forces of demand and supply. But when you start to control interest rate,
yes,
that's the price of credit, then you distort all the other market fundamentals.
Okay.
And what you have at the end of the day is what you call an asymmetric market,
okay,
where you cannot direct supply to the demand that is required, or the demand cannot direct to supply where the supply is.
Okay.
Yes.
So at least that hurdle has more or less, we've gotten over that. So now we are in an environment where the rate cap has been repealed. Mm-hmm. What does that mean at a macro level, at a micro level?
I was just going through the press statement by the chairman of Kenya Bankers this morning,
yes,
on their perspective or their views on the repeal of interest rate caps. And there are two things that Mr. Igara said that I think captured my attention. One is that in as much as the caps has been removed, mm-hmm, the cost of credit will not jump that high. There might be 1 or 2 percentage points increase, but it will not go to where it was previously, that is 24%. Then the other bit that captured my attention was that the cost of credit of the existing facilities, okay, will remain as is, that is as they are. I think that to me is fair, okay, to the market if you look at it that way. But I want to look at this on two perspectives. One, at the macro level, okay, or at the fiscal policy level, and then at the micro level. The private sector.
Okay, so we look at the macro. Let's start at the macro level.
The macro level. When you control interest rates, which in our case, let me call it the cost of credit, then there are two things that happens. One, you don't encourage what we call FDIs, foreign direct investments, because a foreigner would only want to invest in a country where he knows he has a free choice, or rather, the market is such that he can make an informed decision based on the forces of demand supply in the market. But when you control it, then what they do is they look at other markets.
Okay.
In the last 2 years, you must have realized that most of the stocks in the banking industry counters were quite flat. There were very little movements in that sector.
Okay.
That is one of the reasons. That's the reason why.
So we are actually not attracting foreign
yes,
capital to the NSE, and that would explain
exactly,
why the volumes
exactly,
have been coming off in the last 2 to 3 years.
That is very true. That is very true.
So then do you expect a reversion, at least as using the NSE as a proxy to see whether there's foreign direct investments that are coming into the country or not?
If you looked at the way the market responded to the repeal of the Finance Act, I think the first 2 days, most of the counters jumped. Not by a very big margin, but at least there was some positive movements in the banking counters, and I expect that to move in the next 1 year. Of course, you've seen most banks, just as we were discussing when you're off air, most banks are posting very good returns, very good profits. So in the next 1 or 2 years, you'll see most of those counters going up, and therefore you'll expect to start seeing FDIs coming into the country.
Okay.
And that again has an impact on our FX markets, you'll start seeing the shilling either stabling at 103, 104, or slightly going down.
So that would explain what we've seen, because I think the statistics that we saw come out yesterday, 102.05, very impressive. So that could be a level that maybe it remains.
Exactly.
Talk us through then your sentiments when you're, again, going back to the macro level and you're looking at debt. So two things have happened. Rate cap repeal, positive for the private sector, time will tell. Then there's also the element of removing the cap on the lending and putting rather an absolute number, 9 trillion. So what do these two mean? Is there a correlation between the two? Will we expect to see the government going aggressively out into the foreign markets to look for credit? What are your thoughts when you look about at debt today?
Government is a very strong player in the money market. That is through their domestic. Let me narrow down to domestic borrowing, because domestic borrowing is what affects our money market, so to speak. The last 2 years, you've seen government borrowing very heavily in the domestic market as well as the foreign markets. When government borrows in the domestic market, they do two things. One, they start competing with the common population or the private sector. And when government and a private business person goes to the bank, of course they are more attractive because they are almost risk-free. And if the price that they're offering is the same, then you'd expect rational banks, of which they are because they're in business, to extend credit to government. And that is what most banks have done in the last 2 years that the interest rate cap was in place. You saw there was quite a lull in lending to private sector, but lending to government quite almost doubled if you look at 2015 going into 16, 17.
Yes, it
so
did.
that is what happens.
Okay,
going
so then,
into
sorry, I cut you
going
short.
into the future, now that the interest rates have been repealed, I expect government to lower or minimize their domestic borrowing so that the private sector can take full advantage of the repeal of the interest rate caps.
So does that mean, from the last budget statement, I think the government had planned to borrow about 300 billion. So could they possibly reduce that and then go and borrow from the global markets?
I would expect that the treasury economists would be looking at borrowing offshore as opposed to borrowing in the local market. Or if they were to balance, then they would most likely would want to look at 75% offshore borrowing and maybe 25% borrowing
local borrowing.
Exactly.
That's very interesting. I think let's take a short break for the closing bell. Then when we come back, let's try and understand, where is the government making these decisions, and really, so what for you as a person who's living in Kenya? Look out for the closing bell. Don't go anywhere. See you shortly.